everybody, this is Crane, the host of the Inside Crypto Podcast. Welcome back to another episode. It's been 2 weeks, so lots of news to cover this week. Let's get straight into it. Bitcoin currently at $61,713. Ruins protocol sees significant decline in activity. We'll talk about that. Franklin Templeton CEO discusses the benefits of blockchain technology. Hong Kong Bitcoin ETF and Ether ETFs see $39 million outflows on Monday. Farside investors, IMF's 𝕂𝕠𝕕𝕖 warns on fragmenting global trade, economic fallout, and last story for today, Bitcoin price gains ahead of this week's US inflation print. All these stories and more on today's episode, so do not move. Stay tuned. Let's jump straight into the Bitcoin price for today. All right, the Bitcoin price for today is $61,711.73, up 0.9% as of the time of recording this episode. Bitcoin was at $62,000 earlier today when I did look. Data might not be that good in terms of a macroeconomic perspective, hence we're seeing the selling of some kind. Let's not to mention one of the stories we're going to talk about today is the outflows from the Hong Kong spot Bitcoin and Ether ETFs, which might be a signal for this side of the world that, oh my God, things are not looking good. So traditional investors are selling, so as non-traditional DeFi investors should be selling our Bitcoin and Ethereum, maybe, right? We're also going to talk about the economic news as well, because I know a lot of people are very concerned, like, why is this happening? Even if the macroeconomic news is bad, this should be a call for investors to say, oh my God, my Bitcoin is important. I should buy it. I should keep it. I should hold it, because this is going to be the thing that holds me through this tough economic times. We'll talk about that later. There's a lot to dive into there. If you listen to the 21 Shares analyst calls and some of our research team, they've talked about how, because so many traditional investors are in Bitcoin at the moment, all the Bitcoin ETFs in the United States, they're approaching Bitcoin from a traditional finance perspective, which is being that, okay, macroeconomic news is bad, therefore this equals I need to reduce my portfolio exposure. I need to maybe switch into cash or switch into treasury bills, things like that. This could be another perspective to think about. With that being said, let's dive into today's first story. Ruins protocol sees significant decline in activity. Despite generating hundreds of thousands of dollars in daily fees, Ruins has only surpassed 1 million in total fees twice in the last 12 days. So those of you who were busy, like most of you are, you might have missed this idea of Ruins protocol. Ruins protocol was another NFT-like emphasis and like protocol launched after the Bitcoin halving. It did fantastically well. It generated a lot of fees for Bitcoin miners. So of course, we're very happy. So the halving happened on April 20th. It is now May 14th as of recording this episode. And Ruins is not doing that great. But again, people be like, oh my God, this means Bitcoin is not doing great. I'm like, that is not what I'm saying. This is just Ruins. And this is also very typical of new protocols, new ecosystems launching, which might have this amazing hype going up. And then when the reality sets in, when people start looking at all various aspects of the economy, their portfolio, what the stock market is doing, what people are saying about the United States and China and the UK and the European Union and Africa and India and all the sort of various economies, and they're intertwining, people are like, okay, I need to get rid of these risky assets. And so people dump on Bitcoin, or they're like, I'm not going to be doing things on Ruins protocol, or people just not using Bitcoin network anymore. They're using Ethereum, or they're using Solana or something like that. Let's look a little bit more in detail at this story. Data from Dune Analytics shows that until April 24th, Ruins-related transactions made up the majority of transactions on the Bitcoin network. On April 23rd, Ruins claimed its highest transactions share of 81.3%, pushing the Bitcoin transaction share down to 18.15% with ordinals and BRC20 transactions at 0.1% each. That is a tiny fraction. Ruins transactions dwindled consistently over the next 9 days until May 2nd. From May 3rd, Ruins began to recover, gaining its transaction share above 60% on May 4th and May 5th. The mining community welcomed the rising fees as their earnings dropped significantly following the Bitcoin halving, because Bitcoin miners used to get 6.25 Bitcoin per mining a block, and now they're down to 3.125 Bitcoins. In May, total revenue for Bitcoin miners dropped to under $13 million per day. Ruins like Ordinals launched a new token standard on the Bitcoin blockchain. Bitcoin recently processed its 1 billionth transaction. So Ruins is interesting. Again, I'm going to echo the sentiment of our research team. I don't think it's going to go away. But at the same time, I think if you're somebody who's interested in NFT-like transactions or the idea of runes, you're probably doing this on Ethereum or Solana or one of the other more popular networks. With that being said, let's move on to today's next story. The next story is Franklin Templeton, CEO, discusses the benefits of blockchain technology. This is a very cool story. But again, for most of you, if you've been listening to the Inside Crypto podcast for a few years, been almost about 3 years since we've been doing this in various forms, one or the other, you would know that one of the big benefits of blockchain is the cost of processing a transaction compared to the cost of doing a paper transaction or even a traditional finance transaction. We've had guests on when we were doing one guest a week on Inside Crypto explained. Yeah, I remember Sherry Jiang, the CEO of then Blue Jay Finance. She's doing a new thing at the moment. She mentioned like the cost of doing a transaction on the blockchain is like cents on the dollar compared to a transaction typically working in a traditional finance place. It was a few dollars or something along that line. And again, this is what the Franklin Templeton CEO explains, discussing asset tokenization benefits, and explained like when they did an experiment that they were just amazed by the cost of this. And this comes down to the idea, and we've seen this with various asset managers and traditional finance institutions, and even places like KPMG and Ernst & Young and places like that, where they're like, okay, I'm going to help this organization set up their own private blockchain. When the organization sees the blockchain, like, oh my God, I can cut the costs down to cents on the dollar. This is obviously a good idea for me. So we know this, that blockchain technology is good. It's not terrible. It's not a scam. The technology behind it is great. There are, of course, people who do scammy things on blockchain. And there are meme coins, of course, which don't do us any favors when it comes to the public relations department. That being said, yeah, blockchain, wonderful. Check out this article by 𝕋𝕚𝕚𝕖 ₂. Very interesting. And of course, echoing the sentiment we've mentioned on this show many, many times. Well, let's move on to today's next story. Hong Kong Bitcoin and Ether ETFs see $39 million outflows on Monday. Far-side investors. Previous outflows hovered around the 6 million mark, signaling a significant uptick in negative flows on Monday. There's probably a large number of reasons for this. We've seen inflation data in China has not been great, to be honest, and Hong Kong is connected to China at the moment. Of course, this is influencing investors not just in Hong Kong, but here in Taiwan and Japan and Korea, all these sort of quote-unquote developed Asian economies. So of course, when investors see negative macroeconomic data, they're like, okay, as I explained earlier in the show, they want to get rid of their riskier assets, which is Bitcoin and Ethereum and stuff like that. The last part to highlight about this story as well is that lots of people were disappointed by the Hong Kong Bitcoin spot ETFs and Ether ETFs, right? They were like, oh my God, I remember a quote from somebody in Hong Kong being like, this is going to be as big as the United States. But as the CoinDesk article highlights, the market is only $50 billion in Hong Kong. Not to mention, Hong Kong is a very crowded place with lots of people. But cryptocurrency is a thing that's not really talked about here. There are communities. I would say it's much more of a social media thing out in the West, where you can see people talking about it on Instagram, on Facebook. There are groups. There are loads of videos on YouTube, on TikTok, and Reels, right? But here, cryptocurrency, I find, is lots of people do own cryptocurrency, and it is accepted. But at the same time, I guess in a similar, very much similar to the West, cryptocurrency is being used to scam people, not as much as it is in the West, though, but it is still has a negative connotation. So that's unfortunate. So yeah, as the story mentions as well, there's the possibility that mainland Chinese investors could connect to the stock market. There's the possibility that there could be an option for these Bitcoin spot ETFs to launch in the mainland Chinese stock market. Nothing's been confirmed yet. As the CoinDesk article says, that rumor is false. I think the next big thing when it comes to Hong Kong would be mainland Chinese access. Of course, investors in Japan and Korea and Taiwan have their own options. It's not going to influence us too much on this side of the world. All right. Today's next story is from Axios. Widening geopolitical divides are disrupting global trade flows, creating spillover effects that are dividing the world's economies into competing blocks. The top International Monetary Fund official warned this week at a speech at Stanford University on Tuesday. IMF First Deputy Managing Director Geeta Gopinath said that the global economic ties are shifting in ways that have not been seen since the Cold War's conclusion. Induced shocks like COVID-19 pandemic and the Russia-Ukraine conflict are prompting more countries to rethink economic ties based on national security and protectionist concern. This also means foreign direct investment flows are also being redirected along geopolitical lines, Goknath said. Some countries are reevaluating their heavy reliance on the dollar in their international transactions and reserve holdings. Why this matters: growing US-China disputes are a threat to global trade and may prompt other countries to choose sides or get caught in the crossfire. We know this is already happening. I remember seeing something very recently this week that President Biden is going to levy heavy fees on imports of Chinese EV vehicles into the United States, basically making them impossible for anyone to import a Chinese electrical vehicle into the United States. Of course, China is unhappy about that. We know the TikTok thing. TikTok has been banned in the United States, and they have, I think, like 9 months to either sell it or get out, pretty much. Or basically, Apple and Google will ban them from the app stores and the Android stores. And the only way for someone to get TikTok is to sideload it or jailbreak their iPhone, which is another can of worms themselves. And a lot of people believe this was, politically motivated. There were whistleblowers and stuff concerning TikTok. I could make a whole video about the TikTok stuff. And then, of course, there's, India as well. India is very friendly with the United States, but at the same time, they're super friendly with Russia, which is why they haven't called Russia out for invading Ukraine, because during difficult times, Russia was a big friend to India. Same thing in South Africa, my home country. They've not said too much about Ukraine and Russia because, again, during apartheid in South Africa, Russia was a big friend to South Africa and sold us arms. And it's one of the reasons why AK-47s are super popular in South Africa, which sounds like a good thing, but it's not. This is a lot of the stuff that's just been expanding and getting worse and worse. And you have all the Western allies, which include America, most of Europe. You've got Japan, South Korea, Vietnam as it stands is neither here nor there. Taiwan, of course, siding with the West. So it's basically, you've got, quote unquote, the Axis. I'm not going to use the other word for that. It's China, Russia, India. So it's BRICS, basically. Though President Lula in Brazil is another story. A lot of this is creating a lot of economic problems. Ukraine and Russia and the Houthi rebels, all of this stuff we've talked about over previous episodes is not getting any better. So this also is dampening the Bitcoin market, is dampening the Ethereum market, is dampening the overall crypto market. That being said, we've hovered around $60,000 for a while, and that's a good sign. It's showing resilience when it comes to cryptocurrency, but we'll have to see what happens. The last story for today is Bitcoin price gains ahead of this week's US inflation prints. Bitcoin posted an uptick on Monday morning as traders awaited 2 US inflation prints this week. The inflation data could assist in determining whether and when the Federal Reserve might decrease borrowing costs in 2024. We covered this before. One of our researchers said we might be in this high interest rate environment for the foreseeable future. And he's echoed the sentiment by a bunch of different economists that US inflation data is not getting any better. And another article I remember we talked about on the podcast was that they mentioned that after studying purchases in the United States, that inflation is continuing to be higher than what the Fed would like because of the wealthy consumers, people who are still buying lots of stuff and buying because they're wealthy, and inflation and higher prices has not disrupted them at all, right? So recent US economic data suggests the nation's economy is experiencing a slowdown compared to the more buoyant conditions of 2023. US employment data for April revealed weaker growth than analysts had anticipated for the first time in months. If this trend persists, it could exert pressure on the Federal Reserve to cut rates to prevent a significant economic downturn. Consequently, investors are seeking confirmation regarding the persistence of inflation, data that could provide further insight into the extent, timing, and overall likelihood of rate cuts this year. Again, if it does happen, wonderful. If it doesn't happen, we don't know. You guys should check out that CME tool, which allows you to see what the prediction is for a rate cut. We mentioned this in the article. As always, please check out all the articles that we've talked about on today's show. Support the journalists, support the publication, subscribe to the newsletters. I do. And as always, thank you guys for tuning in. Thank you guys for supporting the shorts. I know last week's podcast was a little bit intense, a little bit data-driven. But sites like that are really interesting. I know a lot of you don't have time to go to Dune Analytics, to go to X-Ray, right? To go to Flipside and check out these dashboards, because it does take time to learn it and it's not in your priorities, right? I totally understand it, but I appreciate you supporting the episode nonetheless. I hope you enjoyed today's episode, and then we will talk to you guys same time next week for another Bitcoin Weekly.